This session's for anyone that wants to buy a business, anyone that's been interested to start a business, anyone that is slightly entrepreneurial. And this is the thing as property investors, you are already running a business. Property is a game of business, right? If it is a 5% rental yield and a 5% capital growth, that's a business giving you a 10% return on the value of the thing. So business is exactly the same. So what we actually got is something a little bit different. This week, we're bringing on a guy named Andrew Morello. And if you ever watched The Apprentice Australia, you would have seen he would have won it. He got mentored by Mark Burus, and a super interesting guy. He has literally mentored thousands of business owners about how they can take their investing to the next level in the world of business. But not just that, he is a auctioneer, a real estate agent, a property manager. He's done it all. He's called over 2,500 auctions. He has owned 9 properties throughout his career, residential, commercial, all of this stuff we're going to unpack, but he's got such an interesting insight. So as a property investor, you're probably more entrepreneurial than you think. And is there an opportunity within business for us to take our investing to the next level? Because a 10% return on 5% yield and a 5% growth, that's 10% return. Can we make that any better? Hey everyone, my name is Joe Tucker, and together with Jeff Miles, we created Oz Property Investors, Australia's largest property investment community. We got 82,000 members, and each week we interview top property experts, anyone to do with property. You got to be a fly on the wall as we unpack their lessons learned. And tonight is Andrew Morello of the Entourage. He mentors business owners throughout all of Australia, throughout the world actually, and has some real insights into that space. We've got Steve Polisi as the co-host. Let's dive in. I think you're going to enjoy this one. It's going to be a little bit different. It's going to be a little less Joe and Jeff banter, but it's got some absolute golden nuggets. Let's see. What are some of the clear mistakes that you see property investors that go out and try and buy a property at auction? Like, how can we, because you're there to
I don't know if this is going to be a short answer. I don't know if you're all wondering if it's going to be a short answer.
Inversely, Joe, what's the benefits of selling at auction versus putting it on the market?
Well, let's start with question number one. So question number one, the buying at auction, look, a great auctioneer, and I'm not being arrogant or hubris, but I think I would hope people see me as a great auctioneer. Like, I think a great auctioneer is great at evoking emotion. So I'll repeat the words: evoking emotion, right? Whether it's commercial, whether it's residential, whatever it might be, whether it's horse auction. Like, I've gone and studied horse auctioneers, Anthony Gaffer, the number one horse auctioneer online in the world. He's one of my very close friends. I've watched and studied him. I've been to stock and agent auctions all around the world, including Texas and all around Australia and so forth. So, like, I can see how our stock agents do it as well. I think a great auctioneer evokes emotion. And so, like, one of the challenges of buying at auction, especially in a seller's market, is getting caught up in the emotion of it all, right? And it's not stupid. Like, I helped one of the Entourage staff bid on Saturday via FaceTime while I was in the Gold Coast speaking at a conference. I said to her, "Yeah, put me on with you and your husband to help you bid." And she bid, and her budget was a couple of million. And she was very clearly over her budget at 2.2 million, but she kept on going and she didn't end up getting it, but like, she got caught up in the emotion of buying at auction, right? And that's what a great auctioneer does. He or she evokes emotion in the preamble, and then, like, a great auctioneer can get through the rules and conditions, like, making it feel like it's not a big thing. Yeah, the glory. So certainly one of the pitfalls of auction is that. At the same time, I think if it's your principal place of residence, then I agree going over your budget. Like, I'm like, okay, and this is what I say to people. I go, you're going to buy this place. How long are you going to own it for? Possibly 30-year loan. A 30-year loan at, or a 25-year loan, whatever it might be. Like, you amortize the extra 20, 30, 40, 50 grand you went to buy the home that you really want to be in, that your daughter or son has picked. And, as a good agent, we used to always go like, say to the kids, what's your room? Like it was standard sales operating procedure. Like, how do you, get them to get the children to buy in, get the children to buy in, you get the wife to buy in, you get the wife to buy in, you get the husband to buy in, or whatever. Like, I've worked in predominantly gay areas or homosexual areas where they want to buy properties there, and they dual income owners, right? And it was the same problem. Like, you got two guys making, or two women making 300-400 grand a year. They had like a big account of money to spend. And you would talk to them about, like, is this where you want to be? Yes, it is. Okay, well, look, the auction's booked for 2.4 to 2.6. If it gets to 2.6, are you still going to be in the game? Yes, we are. Like, they're like, okay, well, we've made a decision on this. The thing would sell for 2.9, 3.2 million. We'd get that morning, we'd get an email from, Fair Trading saying you've underquoted. I'm like, man, I didn't underquote. I had two couples that make 300-400 grand each like each individual makes 300-400 grand, and they don't have any kids. They don't have any financial obligations, and they wanted this property. Let me give you the hot tip. This is called the free market. This is called capitalism. Like, they fell in love with it. The emotion kicked in, and now you're trying to have a go at us for being a great auctioneer that's going to draw every dollar out for our vendor who's paying us. And they'd be like, oh, sorry, Mr. Morello, we agree. Sorry, we apologize. And I'd be like, guys, like, I'm not being rude, but like, you've got two very capable couples that are very successful in their own right, and they're wanting to buy the property that is going to be the property for them. And so they're the pitfalls of buying at auction, guys.
Are there any ticks and tactics that we can use? Like, really, it's really who has their hand up the longest, right? Like,
do you want me to? No, I've got a tip and a trick, but auctioneers are going to hate me if I say this. So it's called cooking the auction. So if it's quoted for like 2 to 2.2 million and your budget is 2.3, 2.4, and this is the house you want to buy, auctioneers, the number one thing they hate is called cooking the auction. It's an internal thing amongst the brotherhood and sisterhood of auctioneers. And so basically what we do is we try and start it low. If we're quoting 2 to 2.2, we started at 1.8 on purpose to get everyone involved in the process. There is a tip and trick, which is called cooking the auction. If your budget is 2.2 and they're quoting 2 to 2.2, it's probably going to get there, guys. No offense, in this current market, it's probably going to get there. Maybe in a buyer's market, it's not going to get there. So, like, if your budget's 2.2, start the auction at 2.15. Auctioneers will hate you and you'll get the death look. But if you're trying to buy a property, there's some advice that I've given you.
So what are some of the returns that we should expect from residential commercial? So I guess I'll talk on the residential side of things, that's
Please.
kind of my area. So I guess if you're buying a residential property right now, you can expect, anywhere, the last 30 years, residential properties done 7.2 to 6.9 to 7.2% capital growth year on year, depending on the source that you look at, which is pretty substantial, right? That's doubling every 10 years. And you can expect something like that, 7% compounded, and then a rental yield around that 3.8 to 4.5%, somewhere in between there.
Gross percent as well.
Gross rental yield. Yes, yeah. Exactly. Yeah, that's not net. It's going to be negatively geared. That's something I think that's very important for people that are just starting out buying right now. With interest rates at 6.5%, if your property is at 4%, there is that gap of 2% plus property costs that are going to be on top of it. So if you are buying a $600,000 property right now, it's going to be $18,000 to $22,000 negative a year, which is really challenging in these interest rate environments. So you do have to balance that growth and cash flow side of things. But Steve, commercial. What are we're so I guess that core focus of the we're not losing money in residential for the fun of it. We're doing it because we want that capital growth. We want to choose the right market at the right time to get better than 7%, but on average 7%.
Yeah, it's probably worth saying as well. Residential, like I always explain it like a big staircase. Like residential, you're only halfway down the staircase. Whereas if you trip, you're going to hurt yourself, but you'll kind of survive because there's less things to go wrong unless you're buying like an off the plan or a high density apartment. As long as you don't buy in a flood zone and things like that, you can weather the storms in a well encapsulated city in the middle of it. You can hold it. Commercial, I would say you're at the top of the staircase because there's way more things to trip up on. That you basically susceptible to the business, how successful they are. The vacancy periods are longer. Our due diligence is 80 to 100 pages long. So there's so many more things you can actually trip up on, but you get 2 to 3 times the net return in regards to cash flow. So, and then we can have a chat about like the capital growth, but just on the cash flow, you'll get 2 or 3. Whereas I think Andrew might agree, business, you're probably at the top of a cliff. So you can, sky's the limit, but you can completely flop and lose all your money. So there's that balance.
It's the old bull and bear, I call it.
Yeah. It's like running through the Kokoda Trail, getting chased by hornets while you're blind kind of situation.
But it's also finishing the Kokoda Trail and getting into the, going through the Golden Arches. Like you go through the Kokoda Arches, right? So, there's a moment of elation. Like it's in, and look, there's no right or wrong, guys. And obviously, my disclaimer is this is not financial advice. But I think we live, and it's great to have you. You guys still there?
Yeah.
Okay, great.
Not financial advice.
Thank you. This is not financial advice. I'm just giving you the hot tip. Always, because I got told that very young. Section 52 of the Fair Traders Act, misleading, deceptive conduct. I'm onto it, bro. But
so what can we expect from business though, and how should we frame that? Maybe a white belt business. Like, what would be a white belt business?
Well, one step back. Just what's a typical profit margin for a business? Because that's going to be the equivalent of like the net return when you're buying. When you're spending
typical is anywhere like ideally between 15 to 25% if you're not out of the normal realm. So food and beverage has fluctuations. One of our biggest clients at the Entourage is a big alcohol company in Australia. They work on 7%, but they did like 1.2 billion last year, right? So it's a volume game, right? So you look at that and go, okay, that's that. But like a mum and dad business, let's call it food and beverage, they've got a nice restaurant in Bankstown or Moonee Ponds or whatever. They should be aiming for anywhere between 17 to 25% net profit before tax, and there is tax involved in that. But if you're a small business owner in Australia who's not minimizing their tax, this is not tax advice, but if you're not minimizing your tax, then I'd really tell you to get a new accountant. Maybe
like Kerry Packer, you need your head.
Maybe an Italian accountant, and I've got a couple for you. So I think at the end of the day, if you're running all your costs through, or you're not running any of your costs like lifestyle costs through the business, it's the only way to survive in Australia. Like as I said, this is not tax advice, but I'm like the reality is, small business does afford a good lifestyle. We probably have like 3 kinds of people that come to us at the Entourage from a vision point of view. First one is lifestyle. They want to have a business that does $2-3 million a year with a net profit before tax of like 600K. They look after their staff and they're in a position to go and spend time with their kids. The second group of people that come to us, they're like, okay, I've got 2 restaurants now, and they're called Morello party.com, right? And they're like, okay, we got 2, we got one in Western Sydney, we got one in Eastern Suburbs. How do we go from 2 to 15, right? And that might be, franchising or licensing or whatever it might be, all kept in co. So that's the scale conversation. The third group of people that come to us is like, I've had the restaurant for 20 years and I'm done. Like my wife's over it, my husband's over it, whoever's over it, like it's done. Or my life partner's over it. Can we actually box it up so it is a saleable and scalable asset for somebody else? And so that's probably the big conversation that we're having with people right now. But they're the three sort of like lifestyle, scale, and sale, or some sort of exit of some sort. Like we're working with Peter Hull right now, and Peter Hull was the founder of Fitstop, and he's been their gyms, and like he's looking at different opportunities to work with like venture capital, private equity, and so that's probably the third biggest story that we're talking about right now.
I want to touch back on the numbers because it's probably worth pointing out. So like with property, obviously you got leverage, which is the benefit, is the cash on cash return. But like just off the numbers, if you're buying cash, like Joe, you mentioned, you're probably on a 2.5% net yield plus your 7% capital growth. We're talking 9, let's say 10% return on investment with property, with residential. Commercial, let's just pretend we get less capital growth, let's say 3-4%, but I'm getting 6% net return. I'm getting my 10% with property. Business, like you mentioned, Andrew, 20%. So we're getting twice as much return with owning a business. But there's leverage that comes into it. Residential, you can leverage up 90%. So the cash on cash can be magnified to say, I think when I look, residential is about 18%. Commercial cash on cash, you can actually get up to kind of 18-20% as well. But then you can still leverage business, buying into a business. And like, what's your experience with like what type of deposit do you need when buying a business? So it's $1 million profit business.
Steve, great question. It depends on the business you got, right, or the business you're potentially looking to buy. So we've got some really good lenders out there right now, and like don't anyone yell at me when I say this, but like there's some really good companies, including some big four. So Kudos Bank is somebody who's looking at like cash flow funding and things of that nature. You've got Judo Bank in the property management space. You've got Westpac and you've got Macquarie Bank. They're probably the four that are most flexible right now. So that's like, and I'm not endorsed by any
to acquire a business.
To acquire a business, correct. So to acquire in a business, they generally, a lot of them will try and hit you up straight off the bat. Like, how much property do you own? Can we take that as security? That's what they're going to do. They're not going to want to lose the deal. So then they'll be like, the next level down is like, show me the cash flow of the business and like what deposit you have. So if the owner of the business wants 1.5 million, can you put 500K in cash, or offset against your residential or commercial real estate portfolio? Can you offset it? They may not make you transfer it over, but you may need to sign a guarantor for the properties, which they'll take what we call a second mortgage on the property. So keep that in mind. You can't sell that without their approval. So you just keep that in mind as well. And then there are some very, conventional banks doing that. There is a third option, which is private money, right? And like, nobody likes to talk about it. It's a bit taboo in Australia. I live in Rose Bay, which is a Jewish community, and there is some great Jewish investor families that are keen to invest with business owners that they believe in. So you do need to put a great proposal forward. Same in Caulfield and in Melbourne and Alstonwick. Same across, like, not just the Jewish community, but also the private family money community. Like, they're keen to have a proportion of their portfolio that's slightly high risk, where they'll go, okay, we'll take this punt because you've put a really good business plan forward. So like, a prime example is like, in my world, if you're a successful operator and Macquarie Bank's trying to, extort you for 8% return on your property management book, these guys might go, we'll match the 8% because you don't have it might be no recourse on the no recourse on the loan. They might take a lien on the portfolio that you bought, but like, these are like different things, guys, that like, this is where
so many different variables.
Yeah, but Steve made a really good point before. It's like, getting good advice, guys. Like, don't worry about us in the entourage. I'm just saying, like, in general, get some good advice. Accountants, in my experience, and I've got a great accountant, but in my experience, accountants are very conservative. So, like, there are options out there. Private money is out there, and you could do it as a raising capital. You could do it as a debt funding, which is what they call a conversion note, where you convert the debt into shares at some point. And like, the good operators that are raising capital have what they call buy-sell agreements to make sure that they can buy the shares back when the business, not if, psychology first, when the business succeeds.
Are there any businesses you think that are easier to manage, more hands off, or alternatively easy to scale? Like, are products easier than services? Like, is there a pro and con of each?
We're seeing a lot of product businesses that have never done online. That's one of the big things that we're seeing here at the Entourage. Like, I think what happens is, like, they're selling products already and they got no interest in going online. So I think somebody who's got some online nous or education around it, I can think there's a big opportunity there.
Yeah, I've seen actually in the Entourage a lot of like where they make like custom built certain things, and like you said, they were previously not even doing it online. It was just like
but now that makes up 80% of their revenue. We're talking
automating it online.
$85 million businesses that are selling online now because like they never had anyone to tell them that. Like they're great visionaries or great integrators. There's a great book around it's called Rocket Fuel by Jenna Wickman, around visionaries and integrators. And it's like you get these people that are just like, no one's ever told them, like, you've been doing this, like, why don't you try something online? Oh, my product doesn't sell online. And I'm like, well, I disagree. Like, have you tried? And then they try and they're like, oh my God, you wouldn't believe it. We did $30 million in online sales. I'm like, okay, like that's what happened. Like once you start to get better around like cost per lead, cost per acquisition, return on ad spend, then you can start to, really refine your product to make sure it answers to the consumer's needs.